Hi everyone, let's take a look at Chapter 9, Reporting and Interpreting Liabilities. We're going to look at current liabilities and long-term liabilities in this videotape. Current liabilities, we know from Chapter 2, are short-term obligations expected to be satisfied within 1 year of the balance sheet date or the operating cycle, whichever is longer. Typically, when we buy inventory on credit, it affects the current liability accounts payable. We've seen that if we owe rent at the end of the accounting period and we have not paid that rent, we could have an accrued rent payable and an accrued rent expense. We could owe wages to our employees at the end of the accounting period, so we could have a liability accrued wages for that. And sometimes when we pay customers in advance, when customers pay us in advance, and by the way, the focus company in this chapter is Starbucks, so you should be probably familiar with the fact that people have a Starbucks card that is preloaded, or gift cards, and those would represent cash collected by Starbucks in advance of actually providing the goods or services, and therefore it would create a liability, typically classified as current, called deferred revenue. Typically, the largest current liability is accounts payable for a company that purchases especially a lot of inventory or supplies on credit. And we know that accounts payable are trade payables, amounts that we typically owe to suppliers in the course of normal business. We have a turnover ratio called accounts payable turnover. And this ratio takes cost of goods sold off the income statement and divides it by average accounts payable off the balance sheet. Because it's income statement compared to balance sheet, remember the balance sheet number always has to be an average. In this particular case, you can see that Starbucks has been fairly consistent in their accounts payable turnover ratio. And when you compare it to their competitor, Green Mountain Coffee, and another competitor, Dunkin' Donuts, it looks as if they are paying their suppliers in a much more timely manner. Another way to look at this ratio is to take the number of days in the year and divide it by the 13.4, which was the 2014 ratio, and it's showing that Starbucks is paying their suppliers every 27 days. If you were to take Dunkin' Donuts ratio and divide it into 365 days, you would end up with a calculation of about 59 days. So they're taking almost twice, twice as long, over twice as long to pay their suppliers. We also have accrued liabilities. These are obligations because we've incurred some expense, but it's not yet paid at the end of the accounting period. We saw in Chapter 4 that typically it could be things like rent, utilities, salaries, and wages. So one of the liabilities we're going to look at here is accrued taxes payable. We have many different levels of taxes at the federal, state, and sometimes even local level, as well as foreign if we operate overseas. So you can see that here's the Starbucks footnote that shows the amount of current taxes that they owe to the various levels of government. And you can see that it's a fairly significant number, which has significantly increased over time as the company has continued to grow. We also have accrued compensation. Accrued compensation, if you remember back in Chapter 5, represents things like wages, salaries, and benefits that we owe to our employees. Typically, what would happen is we would debit an expense, whether it be compensation expense, vacation expense, sick days, whatever the type of compensation is, we would have these debits, and then that would then be a credit. Here, the compensation expense is for vacation liability. And we accrue this with the passage of time, even though employees may not take all of those days in the current year. But we show that we have an obligation to pay them for vacation, even if it is not yet taken in the current year. In addition, When they take the vacation, which could be 2 or 3 years, depending on what the situation is with the employer contractually. Some companies, if you don't take vacation within the year, you lose that vacation. Others, you can roll that vacation over year after year. Even sick days sometimes can roll year after year. So it may be years before you actually use those accrued vacation days. In the entry when employees finally do take vacation would be to reduce the accrued vacation liability, and then the compensation, of course, would be that we pay them. You know from your own paycheck that there are payroll taxes that come out of your pay, and there are also payroll taxes that the employer has to pay for you, including Social Security, and they match your Social Security tax. They have to pay for that. They have to pay for the federal and state unemployment, and in some cases, of course, workers' comp. So recognize that there are many different obligations that deal with these payroll costs and taxes to employers. And here's an example of a journal entry where, again, we would recognize compensation expense, and we would have a credit for liability for income taxes withheld from the employee's pay, the FICA that is withheld from the employee's pay, and the cash, which would be the net pay. So think of the compensation expense as the expense and the cash as the payable. Now, a lot of times we don't pay the payroll as we accrue the expense, so this might have been a compensation payable. And then when it's finally paid, it would be a reduction to the compensation payable and a credit to cash. So it depends on how they treat these compensation expense and when they actually pay them. They then show you the entry where the employer has to come up with money out of their pocket for FICA, a matching of what was withheld from your pay, as you can see for FICA. And also they have to come up with unemployment tax, which is split between federal and state. We also have deferred revenue. Deferred revenue is where a company has collected or received cash prior to providing goods or services to the customer. So those value cards or gift cards are a liability when Starbucks receives the cash but hasn't redeemed them. At the point at which they are redeemed, that is when the liability would come off the books, and they would then recognize revenue earned. Notes payable can either be long-term or short-term, so they can fall under both current and long-term liabilities. But a note is a formal written promise to pay, including interest. And over time, the principal plus the interest has to be paid. And typically the interest is stated as an annual rate, and it would be affected by the length of the loan. The calculation of what we call simple interest is principal times the annual interest rate times the number of months divided by 12 months if it's for less than a year. If it's for more than a year, then it would be the principal times the annual interest rate times the number of years. So at the time that money is borrowed, cash comes into the company, and we increase that asset and recognize an increase to a liability, notes payable. When we pay it off, we will pay back both interest and principal when it's due. Now, a lot of times with short-term notes, they will not require a payment of interest within the period between when it's borrowed and when the principal is due. But if they do, then we would have to calculate the accrual of interest for November and December if our fiscal year ends in December. And then if we're paying interest twice a year for the year that it's borrowed, first on April 30th, we would recognize 6 months of interest there. And then finally, on October 31st, we recognize the remaining 6 months of interest paid plus the repayment of the $100,000 principal. So they give us an example. They said if we borrow the 100,000 and it's a 12% interest rate, and since that's annual, it's really 1% per month. For 2 months, the interest would be 2,000. So the adjusting entry to accrue the interest payable at the end of the year, December 31st, would be a debit to interest expense and a credit to interest payable for 2,000. So that's the entry that would be recorded here. In addition, when we pay the first 6 months of interest, which would equal 6,000, and that would be here on April 30th, we're not repaying the principal, just the 6 months of interest. So first of all, we would take the payable off the books for 2,000 that we put on December 31st, and then we would record a debit to interest expense for 4,000, which is the period January 1st through April 30th. And of course, cash would go out in the amount of 6,000 for the 6 months of the loan. Finally, the last transaction would be a credit to cash for 106,000, and there would be a debit to interest expense for 6,000, and a debit to notes payable for 100,000, because we would have to repay not only the final 6 months of interest, but the repayment of the principal of the loan as well. A lot of times, long-term debt comes due in a series. And in that case, the portion that is going to come due within 1 year of the balance sheet date would have to be reclassified as a current liability. So if we had a long-term note on December 31st, 2015, when we prepare the financial statement, the balance sheet a year later, if we're going to pay half of that note off in 2017, then what we're going to do is have to classify of the $5 million, 2.5 million in current, and the other remaining 2.5 million in long-term liabilities. At the end of December 31st, 2017, we already paid this 2.5 million, but now the long-term liability is going to come due. And so for 2018, at the end of 2017, we want to show that the remaining 2.5 million that wasn't paid off has been reclassified as current. Why is that important? Well, it's important because current liabilities affect liquidity. And liquidity is the ability to pay your current obligations as they come due, primarily by liquidating your current assets. So knowing that we have increased or decreased liabilities, especially those that are current, is very important. They talk about refinancing debt, whether it be current or long-term, and should it be reclassified from long-term to current. In the U.S., we have to show at the end of the accounting period that we have both the intent and the ability to refinance a loan that would otherwise have been reclassified into current liability from long-term liability in order to keep it in long-term. So recognize that as long as we show that we have the ability and the intent to refinance, we do not have to reclassify the portion of long-term debt as current. A very important concept is contingent liabilities. These are liabilities that will not be settled until the future, and we don't know the exact amount of the contingent or current amount that could potentially be due in the future. And so that's why we call it a contingent liability. Some event has occurred. We know we have some sort of obligation, or we're pretty certain we do, but the estimate is sometimes difficult to make. So they give you an example here of a contingent liability. Assume Starbucks estimates that it'll have to provide $150,000 of warranty service to customers who purchase their coffee brewing and espresso equipment during the year. In this case, because they can estimate the amount, make a reasonable estimate, perhaps based on past history, and because we're reasonably certain that we're going to have to fulfill these warranty claims, we're going to do an adjusting journal entry where we debit warranty expense and credit warranty payable. This is a contingent liability that is accrued because it is both probable we're going to incur these warranty claims, the liability, and we can make a reasonable estimate. So it's a two-pronged test. It's probable that we're going to have to satisfy an obligation, and we can reasonably estimate it. However, there are contingent liabilities that are only recorded in the footnotes because they may be probable but not estimatable, or they may be reasonably estimated, but they may not be probable. They may only be possible. And so in that case, we would disclose those in the footnotes. So they give you a little table here to help you. If the amount can be reasonably estimated and it's probable, okay, then we're going to record it as a liability, as we did with warranties. If the amount can be estimated, but it's only reasonably possible, we're going to disclose it in the footnotes only and not do an accruing entry. If the amount cannot be estimated, then it's only disclosed in the footnotes, whether it's probable or reasonably possible. Remote isn't disclosed at all. So remote says the chance of the future event or events occurring is slight. Probable means it's likely to occur. And reasonably possible, maybe not, about a 50-50 chance. So when they talk about the degree, they do give you certain percentages and standards that you can use. At this time, I'm not really worried that you know those standards. Working capital affects liquidity because working capital is the difference between current assets and current liabilities. As a company grows, typically working capital will grow because typically current assets will grow faster than current liabilities, although that is not necessarily true. What I want you to focus on is the effect working capital accounts, current assets, and current liabilities have on cash flow from operating activities. We saw that when current assets go up, it has an indirect negative effect on cash flow from operations. When we're able to decrease those current assets related to operations, it has a positive effect. Conversely, when we increase current liabilities, it has an indirect positive effect, typically because cash didn't have to go out during that accounting period. But when current liabilities go down, it has a negative effect on cash flow from operations. Let's take a quick look at long-term notes, and then we're going to go on and talk about compound interest. So long-term liabilities are those obligations that will not be paid within a year of the balance sheet date. And typically for most companies, they're notes, or some companies sell bonds in the bond market, similar to issuing shares of stock in the stock market, except bonds are debt instruments. We're only going to focus on notes payable. There is an appendix that talks about the accounting for bonds and the accounting for long-term investments. That's a topic that I feel is more relevant for upper division courses for people who are going to major in accounting. But what I want you to realize is that long-term notes are classified as long-term because they will not mature within the upcoming year. But we've already seen that when those notes do come mature, we will have to reclassify them to the current liability section unless we can show both intent and ability to refinance them by the end of the accounting period. A lot of times, companies do operate in foreign countries, and as a result, what they do is they have foreign currencies, and these foreign currencies open them up to rate changes and open them up to changes in those rates. And the key is that a lot of companies that operate in foreign countries borrow in foreign currencies as a way to hedge against the change in value of the assets on the books that they have in the foreign countries. So borrowing in foreign countries is a way to, one, hedge against rate change where you have assets that are denominated in that foreign currency, and two, you may actually be able to have a lower interest rate depending on the country in which you're borrowing. I want to finish by talking about lease liabilities. The lessor is the one who owns the asset and the party who is granting the lessee the right to use those assets. There are two types of leases: an operating lease, which is strictly a short-term rental, and a capital lease. If you remember, Lowe's had capital leases listed under property, plant, and equipment. They had equipment under capital leases. That means that they actually have obligations listed under long-term debt connected to those capital leased assets. So how do we determine if a lease is a capital lease or an operating lease? There are four criteria, and if any one of these four criteria are met, then the company must classify the lease as a capital lease. And that requires them to show both the value of the leased asset at the present value of the lease payments and the obligation on their balance sheet. So the four criteria are that the lease term is 75% or more of the asset's expected economic life. So, for example, let's say the asset we're leasing is a building with a 50-year life. If we are only signing a lease for 10 years with renewability for 10 more years, then 20 years is only 40% of the expected life of the asset. So that would not be a capital lease. It would be what we call an operating lease. However, if we're renting or signing a lease agreement for 40 years, that would be 80%. So this criteria would be met, and we would have to treat it as a capital lease. The contract between the lessor and lessee could transfer to the lessee ownership at the end of the lease term. Well, that would automatically make it a capital lease. Or the contract may permit the lessee to purchase the asset at what we call a bargain price, which is significantly lower than what the fair value of the asset would be at the end of the lease term. That would also make it a capital lease. And when the lease is signed, if the present value or discounted value of the total lease payments equals 90% or more of the fair value of the leased asset, in other words, what we could buy it for right now rather than leasing it, then that would qualify it as a capital lease. So remember, it doesn't have to meet all of these, just one of these will trigger it being recorded as a capital lease. If we enter into a short-term operating lease to rent some delivery trucks, then it would simply be a debit to rent expense for $10,000 and a credit to cash for $10,000. That's the way it would look if we had operating lease. If we have a capital lease, here they tell us the accountant has determined that the lease is a capital lease with a current cash equivalent value. This means the interest has been removed, so we've discounted the payments down to their present value of $250,000 at the time that the lease is signed. We would therefore put an asset on the books, leased equipment, and we would put a liability, lease liability, on at $250,000, making both assets and liabilities go up by the present value of the lease payments. So now we're going to take a look at how we come up with the present value of those leased assets.